All right, next question comes from Twitter, and it comes from Joe. Thanks for giving me a hot tip. I had cash in my Roth and bought 500 shares of Amazon at $185. Wow. Now, along with 3,000 of Microsoft at 30, should I diversify or hang tough? I have 13 years to retire. Aloha, Joe from Hawaii. Oh, aloha, Joe.
Aloha indeed, because at those prices, Joe, you're sitting on some very, very nice gains. And
I think we need to go see him in person to answer this question, to really give it the attention it needs.
I mean, it seems like it wouldn't be, I mean, he could probably fly us all out there based on what
Thank you, Joe. We look forward to receiving our tickets in the mail.
This is, this is going to be a unique question that everyone has to answer, right? And we often talk about buying and selling and when is the best time to sell. All sorts of reasons to sell. Either your thesis is busted, the company's not working out for you, it's just been a bad investment, or perhaps you need the money for something else. Perhaps you feel like the money is better allocated somewhere else. Or perhaps, as could be in Joe's case here, given what we know based on the information he's given us, it's possible that he may be losing a little sleep at night thinking, wow, I've got a lot of money now allocated to these two individual companies. Now, I can't tell from this email or from this tweet how much this makes up of his overall investment portfolio, but I'd venture that it's, somewhat significant. In that case, I personally would probably look at maybe spreading that money around a little bit. I mean, usually when it comes to IRAs, I mean, everybody's tax situation is unique, but when it comes to IRAs, you can buy and sell, and you're not going to worry about tax implications there. I feel like with that type of gain, it probably is worth looking at spreading that money around a little bit. And I think the reason why I say that for Joe is because not only is he saying he has 13 years to retire, but he's actually saying retire. And I mean, a lot of people out there are gunning for retirement, right? They have that in their mind. And I think about retirement, it's a bit more abstract. I mean, I'm not necessarily wanting to quit my work anytime soon, so my investment decisions are a little bit different. But when you're looking at that, it might be time to start focusing a little bit more on protecting your wealth. Maybe take some money off the table there, put them into some lower risk, perhaps some dividend style investments there, because Amazon is clearly a growth story. Microsoft, a little bit less so, but it's a big tech company nonetheless. So I would definitely look at maybe spreading that out.
Ross, you probably get questions like this a lot.
I do. I was actually going to ask Jason, what is your threshold when you see a single position in a portfolio? Where do you start getting uncomfortable?
See, this is where I would say do as I say, not as I do, because I think I have a much higher risk tolerance than most people out there. And a part of that is because of the nature of my job. I mean, I've had a position at 40% of my portfolio before, and it didn't really cause me any concern. Again, I kind of knew what I was doing.
And you don't feel like you're 13 years from retirement? I
am not 13 years from retirement. I've told David Gardner personally that I will work here until he kicks me out of here. So hopefully that's never. And knocking on 46 here, I think I still have a number of years left, to contribute. But yeah, I think a lot of people, I think 20% is that number. They think 20%, whoa, that's where I'm starting to lose sleep. And I think that number is just different for everyone. And it depends on your age, too. If you're in that stage where you're growing your wealth at 20, 30, 40 years old versus 50, 60, maybe you're focusing on protecting your wealth. That's where you have to assess. And like I said, it's going to be different for everyone. But I think given what we know here, based on the math, that's a pretty big position in both of those companies. It'd be worth probably looking at spreading that risk around a little bit.
Yeah, the final thing I'll say on it, I would do the math personally and say if the company lost half its value, if you chopped it in half, would that change your plans? And if it would, it's probably too much risk for you.